Hello, everyone, and welcome to the Buck Stops here. I'm Catherine Murray. Well, we're always trying to provide you perspectives to make better and informed decisions about your livelihood, your prospects, your investments, and where we go from here. As we know, we saw some major moves, upward moves in the market this week, up by about 5%, as investors are really looking at the US Federal Reserve and saying, wait a second, you are raising rates too aggressively, and you might actually cause a break in the system. And therefore, we saw the equity markets risk on assets move higher. At the same time, we had concerns overseas with respect to Credit Suisse and wondering whether or not their financial stability will be intact. That was something that actually got put to the sides in terms of the markets. And then we also had the UK Prime Minister have to pull back on her monetary expansion plans, which caused the rate markets to really move in incredible ways and very, very volatile. So the fact that those two key events didn't continue to play out in the market, I find quite interesting. And what that tells me is that the story is all about the US Federal Reserve, has been since the financial crisis and apparently continues to be. So who better to get perspective from on that point other than Danielle DiMartino Booth? She is the CEO and chief strategist for Quill Intelligence. It's a research and analytics firm. This follows her career on Wall Street, and also key here, a former Fed advisor. Danielle, great to be with you. Thanks so much for joining us today to give us some perspective.
Thank you for having me.
So, Danielle, I do want to get your thoughts in terms of what you're seeing in terms of the financial markets globally and whether they're unstable given those two key events this week. What's your read on that before we even get to the Fed?
Well, it is very unsettling to see big low points and big high points. The volatility, the swings, they really are unsettling. And they bring me back to a time, 2000, 2007, 2008, when we saw similar swings. And they were indeed broadcasting that there were fissures in the financial system, that there was risk breaking out. They raised red flags for us to pay better attention.
And so it's interesting, though, that the Credit Suisse situation seems to be isolated, that there aren't systemic risks. And, we're not going to get into the details of what's going on at Credit Suisse per se, but it does bring it back to the fact that all eyes, are on the US Federal Reserve because people were willing to put the Credit Suisse situation aside and say, look, it's all about the US Fed. They're raising rates too quickly, and they're going to be causing breaking points within the financial system. What do you say to that?
Well, there is very real concern. It was very strange this week. We saw the World Bank, the United Nations, entities that would not normally comment on such things as Federal Reserve policy come out and say the Fed is going too fast and too strongly. We saw the Reserve Bank of Australia. They had half as much tightening as what the market had been anticipating. There was some rumblings out of the European Central Bank that maybe they're looking for a pause down the road and a big rally in risky assets because people are saying, you know what, maybe there's coordination here among central banks. Maybe the Fed is also looking to pause after this next November rate hike.
And what do you think? What do you think they're going to do? Do you think the market's right in terms of their interpretation?
Well, I think that Powell has tried to emphasize that he really is data dependent. So if we continue to see hotter than expected inflation prints out of the United States and big rallies that loosen financial conditions and thereby give Powell license to tighten further, I think that they press forward. Again, especially if we continue to see the very lagged effects of record home prices, record rental inflation filter through to the consumer price index with a lag.
And so that's one of the key issues, right? And people have criticized Powell and the Fed for being too backward looking in their policies.
Yes, and there's something to be said for that when you see the largest decline in job openings in the United States. That was an August print, and that suggests to you, especially with the lack of hiring that we're seeing this holiday season, that there really is a real-time slowdown happening in the jobs market that the Federal Reserve is following so very closely. Again, driving through the rearview mirror, that's my constant analogy these days. It's not the best way to get from point A to point B.
And to me, one of the biggest, issues and the elephant in the room is I don't know, other than causing a hard landing, which is what the market's been concerned about, how raising rates will really combat inflation? I mean, there has been a massive supply demand destruction equation within the energy sector in the United States. We're going to take a quick break. We'll pick it up after the break. Danielle, I want to pick it up on the idea that the US Federal Reserve can combat inflation by raising rates aggressively. Yet, one of the key reasons why we have high inflation is the cost of energy, which has been a decade in the making in terms of not allowing supply to come back online or to continue to build supply. Why there's such a disconnect? How do you make sense of that in terms of what the Fed's doing, what they're trying to achieve?
Well, this is where you have kind of the political stress meeting up with monetary policy, and where you see the failings of monetary policy. There's so little that Powell could theoretically do in terms of making sure that pipelines get in the ground, so that there is the chance for greater energy independence from the United States, lower imports on our parts, the ability to refine what we pull out of the ground. So there are a lot of complicating factors. And I heard another interview a few days ago that showed that for all of the efforts that have been made in sustainable energy, we still largely rely on the traditional type of fuel that we pull out of the ground, which scientists have shown to be reinventing. The Bakken Shale reinvents itself. So you have to wonder if the investment's not going in the wrong direction, and if the Fed is thereby helpless to combat what's happening in the energy patch.
Right, which leads to the question of how does this turn out? I mean, what does it end up looking like? Maybe the U.S. Federal Reserve will actually stop raising rates as aggressively. I mean, you wrote a book called "Fed Up: An Insider's Take on Why the Fed is Bad for America." I mean, what if you were advising now? Would you want to see them do?
Well, I do think that there is something to be said for getting the Fed funds rate up to a certain level and then pausing and seeing how policy plays out. The elephant in the room is that the Fed is actively engaging $95 billion a month in reducing the size of its balance sheet. The last time we did this, QT1, quantitative tightening 1, it really did not mix well with raising interest rates at the same time. The markets treated it, rightly so, as a form of double tightening because there was so much liquidity being pulled out of the system at the same time. The risk is that what we're starting to see, which is a pickup in defaults, a pickup in bankruptcies, that is going to flow through more rapidly to the real economy. And we are indeed seeing this because the Fed's current tightening campaign, if you look back to 1980, is 3 times as fast the pace of any other tightening cycle that we've seen in recent times.
Yeah, and Danielle, I'm curious because you really get a lot of mixed views when you listen to various people on news, business news networks saying that, in fact, I saw Kevin O'Leary this morning on CNBC saying he's not seeing any slowdown, that the revenue is still, what he would expect it to be. But yet you also have CEOs announcing layoffs. What kind of pain do you think is really being felt by middle Americans?
So when you say middle Americans, that really is where the pain is being felt. We've increased the food stamp program, the food assistance program here in the United States, for example, by 25%. The social safety net for the lowest income earners really is much more substantial than it is for middle income, hardworking Americans who are being hit the hardest by the highest rental prices that they've seen, and the fact that they cannot get into a home. Affordability is higher than it's ever been, including leading up to the housing bust. So, and again, we are seeing increased numbers, especially of middle management layoffs. It may not be manifest yet in the jobless claims figures, but that has a lot to do with the fact that so many of these jobs involve severance, which is good for a time. But again, the pace of layoffs is appreciably picking up. We saw Stanley Black and Decker lay off 1,000 people in its finance division just last week.
Hmm.
These are real numbers. These are real people with real jobs.
Hmm. Right, and we also saw the Vision Fund layoff people, and also Meta, Facebook announced layoffs, which I think was the first time, perhaps in their history. Um, so it's interesting to see though this delayed effect And to your point, the pace that the Fed has really acted and what the ensuing results are going to be, we might actually see it tomorrow in the jobs numbers. Today, we saw the continuing claims move higher. And just so everybody knows, we pre-tape this on the Thursday before the Sunday that it airs. But we might be getting a little bit of that indication, Danielle.
That's very well the case. If you look back at how quickly job openings, which at an absolute level are still very much high, if you look back at the pace at which job openings are declining, that's always been associated with a material increase in the unemployment rate. I think we'll see that pan out these next few months.
Okay, let's take a quick break. We'll be right back. Danielle, we're trying to really figure out what is actually going on in the U.S. economy. And you are saying that there is, in fact, a slowdown, that you're seeing it in middle America, you're seeing it in middle management, and, almost kind of like just wait till what happens next. And the reason why I want to have these conversations is because it's just so easy to listen to like 2 minute, talking heads on television and not really getting into the details. I know that you just interviewed Lacey Hunt. I want to, maybe you can provide perspective in terms of why he's such an interesting and important person to interview, and what your key takeaway was from him.
So Dr. Lacey Hunt started at the Dallas Fed in 1969. I landed there about 40 years after him, but we both consider ourselves to be veterans of the same institution, if you will. He is a font of knowledge. He remembers back to prior financial cycles when markets were not so dependent upon the Federal Reserve policy, when the tail was not wagging the dog, when financial market participants were not the ones dictating monetary policy. That's actually the wrong order of things. And he has some very salient suggestions. We spoke before the Credit Suisse drama broke out, but his solution would be that the Federal Reserve has something called a discount window, always has had a discount window, a way for hobbled banks to come with the collateral that they have and work on an individual basis with what they've got on their balance sheet, as opposed to being bailed out. And there's a critical distinction there, because investors have grown accustomed to, whenever anything goes wrong, whether it was a great big hedge fund in 1998 following the last time Russia defaulted, the Fed coming to the rescue, or the aftermath of the Bear Stearns Lehman event when the Fed marched in and bailed out AIG the very next day. These are the seeds that plant what we call moral hazard, when investors take on more risk than they otherwise would, because they operate under the assumption, you know what, the Fed's got my back.
And you write or talk about the fact that the Fed was not designed to be an allocator of capital, but that's
No,
kind of where we're at, isn't it?
it is. In fact, I think that the main distortion right now that is Jay Powell's nemesis is, again, this lag that we see between when house prices show up in the consumer price index and when house declines, which are happening faster than we've ever seen them filter through eventually 2, 3, 4 quarter lag into the CPI. It was the Fed itself that interjected itself. It conducted credit easing by buying mortgage backed securities, by identifying, you know what, we are going to help out homeowners and we're going to feed speculation and keep interest rates inappropriately too low for too long, and thereby create this monster that they have to then come in and combat, which is exactly what's giving them so much trouble today. It's housing that's created the deepest, stickiest traction in the inflation metrics.
And it's this never ending cycle. And I'm wondering, well, if you go back historically, though, I believe that Dr. Lacey Hunt also talked about what happened in the 1920s and how dissimilar it is to today. So maybe we've always kind of had this type of intervention or this relationship between politics and monetary policy. Maybe you can weigh in on that. But also, then I think the question for everybody at home: okay, great. Now what? What do I do? How do I protect myself amongst these big institutions? What do I do?
Well, it's extremely difficult. Again, if the Fed is choosing winners and losers, and the individual investor is the one that gets left in the middle and not able to be as nimble as some of these larger institutions or some of these great big banks that know that they're too big to fail, so to speak. And it's an extraordinarily difficult operating environment when smaller investors have really no choice but to say, if I can get 4% for 2 year money, I might just take that to the sidelines and wait it out while a potential financial crisis erupts, because of the fact that central banks have pushed this experiment so very far that you wake up one day and say, oh, there's a central bank halfway around the world that's completely affected how I should be investing. The typical investor in North America should not have to be paying attention to monetary policy in Sydney.
Right. No, that's so true. And even the UK, I mean, that really roiled the pullback in the expansionary plans, really roiled the rate market, let
Mhm.
alone what's going on in the currency markets. I mean, people are kind of, not everybody needs to be, you got to, if you're a currency trader, you are strictly a currency trader, right? If you're in equities, it's equities. I mean, to know everything is far too hard, even for the people who do this 24/7. So, a lot to take in for sure. When you say, and we've just got a couple seconds left and we can pick it up, but financial crisis, do you think that there's one looming? And then we'll pick it up on the other side of the break.
Look forward to it.
Really? Okay. All right. Let's quick break. We'll be right back. Welcome back, everybody. I just want to be really clear when we're talking so much about the U.S. Federal Reserve, and for my Canadian viewers, of course, this is global in terms of how we access information today. But for my Canadian viewers, we're doing this because what the U.S. Federal Reserve does impacts all of us in terms of how they affect the markets, the risk assets, and of course also the BOC, which, by the way, is still expected to raise rates by 50 basis points on October the 26th. That affects what you pay on your credit card, your home, your auto, and of course what the bank pays you for your deposits, etc. So back to my previous question in the other segment, Danielle, which is, do you think that there's a financial crisis looming?
So I mistakenly said I look forward to it. I do not look forward to a financial crisis breaking out. But we have to understand that headed into the pandemic, there were already signs. There were already signs of breaking in the credit markets. And what we did to resolve the moment of the pandemic was to actually bring interest rates so low that we invited much more credit and debt building into the system. And now you see headlines. The International Monetary Fund, they've had to bail out Sri Lanka and Ghana. There are many other countries that are suffering because the US dollar is so strong and they've loaded up on so much debt. And the reason I worry about a financial crisis is we have similar situations in the non-financial, in the what we call the corporate debt market. And there are many, many companies that have overloaded on debt. And whether you're talking about Moody's or Standard and Poor's or Fitch, you've had credit rating agencies come out these last few days and seriously increase the default rate assumptions. They're saying, wait, a lot more companies are going to be going out of business because they've taken on debt loads that are simply untenable unless you keep interest rates at the zero bound. And we're certainly not there. And it appears that the Fed's not finished yet. That again brings us back to what we were originally talking about. At some point, something could break.
Yeah, something could break, and it's everybody's guess, really, even though
Mhm.
everybody in the business doesn't want to say they're guessing. But we've got to predict. And given the set of circumstances, you have to decide in your own mindset whether or not you think that the US Federal Reserve will actually recognize, as the market's telling them, you're going to break something. You got $50 trillion of debt extra, interest rates on interest payments with a higher interest rate. I mean, let alone corporate debt at a higher rate, rolling over. What industries are at risk there in terms of needing to renew their debt and at a higher
Mhm.
rate, let alone people with variable mortgages. I mean, if we were a betting set of professionals here, what do you think the Fed does? We kind of talked about this going to keep raise, but then maybe hold.
I think that the Fed is hoping that they're able to bring rates up to a much higher level than what we're used to. Maybe even have the flexibility to not have to go back down to the zero bound. Maybe they take the Fed funds rate to a new floor of 2% going forward. But again, I would raise the issue of quantitative tightening, of reducing the size of the Fed's balance sheet, alongside, by the way, other central banks doing the same thing. The liquidity being pulled out of the system is quite extraordinary, suggesting that the Fed will have to potentially hit the brakes in 2023 if we get that far, because there are so many areas of fragility. I saw that between non-financials and sovereign debt, there's $1 trillion of refinancing on the docket here in the next year or so. And you raise the very salient point that's less familiar to us in the United States, that so many other countries with very overvalued balance sheets do use variable adjustable rate mortgages. And the prospect, I've been writing about this, that we see a balance sheet recession in the Nordics, in New Zealand, in Australia, and boy, especially in Canada. They're very real prospects, and balance sheet recessions take much longer to play out. They leave a lot more scarring in the economy. And we have to bring China into the picture ever so briefly, because those foreign buyers are simply not there as a backstop the way that they were in the aftermath of the last financial crisis.
And just to pick it up real quick on the Canadian front, what do you see occurring here?
Well, as fast as home prices appear to be declining, as fast as bubbles in particular areas appear to be coming off of their highs, it's happening faster north of the border in Canada. And it should be, because there was a greater degree of overvaluation in the Canadian housing market. And again, there was more of a reliance on foreign buyers in Canada than what we had in the United States in certain markets, Miami, Los Angeles.
It seems as though the buyers, the foreign buyers, apparently the money is still coming in here because they want to exit other countries. We'll see if that can continue. Danielle, great to be with you today. Thank you so much for all of your insight and wisdom. I appreciate it.
Thank you for having me.
Thank you. And thanks everybody for watching. Stay tuned for more on The Buck Stops Here.